fellow traders and value investors, and welcome back to another video. Today we continue our series Start with the A's, and in this episode we're looking at Fidelity National Financial, ticker FNF. We'll break down the company, its fundamentals, the risks, and whether the stock might be undervalued or fairly priced today. By the end of this video, you'll know whether Fidelity National Financial is selling at 50% discount or not. Let's dive right in. Fidelity National Financial, or FNF, is basically two companies in one. First, it's one of the largest title insurance and real estate services companies in America. Whenever somebody buys a home, refinances a mortgage, or closes a commercial real estate deal, FNF earns fees, commissions, and insurance premiums. This is the core engine of the company. And the second, FNF owns majority stake in F&G, a fast-growing annuity and life insurance business. People buy annuities, F&G invests the money and earns the spread. This part of the business contributes almost a third of the company's earnings today. So think of FNF as a combination of real estate activity plus insurance investment income. One side is linked to the housing market and the other side is linked to the interest rates and credit markets. When both are working together, FNF prints cash. Let's look at the financial performance. Revenue has been stable year to date 2025, slightly ahead of last year. Title business delivered an industry-leading margin of 17.8% in the last quarter. This is very high for this industry. This improvement comes from higher commercial activity, better refinancing volumes, great cost control, and still strong investment income on escrow balances. On annuity side, asset under management before insurance hit 71.4 billion, up 14%. This provides FNF with a second profit stream that doesn't depend on home sales. We'll now look at the financials in trading view as well. Come to the balance sheet, we can see the steady growth in the revenue over the last quarters. We can see the same over the last 2-3 years. We'll come to the balance sheet. We can see that the net debt is at 1.23 billion and is been going down over the last 3 years. And the free cash flow of 6, 7, and then 6.4 billion now over the last 3 years. If it comes to the statistics and we'll look at my favorite metrics, we can see price to earning of 13.5, slightly higher than last year. We can see that the debt to equity is 0.57, slightly above what I like it to be. And current ratio is not reported. Due to the nature of the business, the current ratio would not make sense. A better metric would be loss ratio or combined ratio. Bottom line revenue is stable, margins are improving, and the company is generating strong cash flow to support dividends and buyback. So is Fidelity National Financial selling for 50% off? According to Philtown, not yet. I used 20% growth EPS growth rate. When I was doing the research, I found different sources reporting it differently. Over the 5 years, the stock is expecting to grow its EPS at around 17%, 25, 27%. So I use 20% of more of an average or more conservative number. And according to this number, using Philtown's intrinsic value calculator, we get a stock price of 45% if we would buy it at 50% discount, which is not too far off from the $60 per share that the stock is selling at the minute. Using the other two calculators, Warren Buffett's intrinsic value calculator, we get a stock price of 58, which is not far off from the current price. And according to Peter Lynch's intrinsic value calculator, the stock is very undervalued. I used the last 4 quarters dividend and the dividend yield, and I've used the last discount rate for 10 years notes. Looking at my classic bear-based bull case scenario, I've seen that the title escrow transaction volume, especially commercial titles, were the main driver for the company's revenue. So I use the commercial title deals as the driver for the next 5 years EPS growth and stock price valuation. In a bear case scenario, if we see commercial deal momentum slow sharply, margins compress towards 14% in the title segment, we can see a EPS over the 5 years of 6.40 and price to earning between 8 and 9. and the stock could be valued between $45 and $55 per share. In a base case scenario, commercial title growth stays strong but moderate, title margin between 17 and 18%, which we are seeing at the minute. We could see the earnings per share growing to 7.7 in the next 5 years. That would be a price to earning between 11 and 12, and the price would be valued between 55 and 65. And in the bull case scenario, if we see commercial title boom, margin expanding towards 20% in the title business, we could see the earnings per share growing to 9.2 in the next 5 years, and the stock could be valued between 55 and $80 per share. Looking at the probability case scenario, we could see that in a bear case scenario of the next 5 years would expect 0% return, 35% return in the base case scenario, and 85% in the bull case scenario. That would make a total return of 39% over the next 5 years, which will make it a compounded annually of 650 to 775. So in conclusion, according to the three calculators, two of them mark the stock as overvalued and one mark it as undervalued. The stock is not currently at 50% according to Phil Town's calculator, but is not far off. And according to the probability case scenario, we could get a 6% to 7% compounded annual growth over the next 5 years from the stock if we buy it at the current level. Before you invest, here are the big risks you must understand. House market risks. FNF title business depend on home sales, refinancing, commercial deals. If rates stay high or volume drops, earnings fall. Interest rate sensitivity. The company earns a lot of money from interest on escrow balances. Management already warned this will decline as the Fed cuts rates. Credit risk in FNG. FNG's investment portfolio includes corporate bonds, structured credit, alternative assets. If credit spread widen or default rise, earnings take a hit. Non-GAAP adjustments. Adjusted earnings remove a lot of noise, mark-to-market movements, alternative investments volatility, reserves changes, tax adjustments. This makes results look smoother than reality. And then the last one is the regulatory dependence. Most of FNF cash come from regulated insurance subsidiaries. Regulators can restrict dividend payment during the stressed periods. Turning to the charts and zooming out a little bit, we can see that the stock have found some resistance at the $30 per share level in about 2018-19. It finally broke through it, then the pandemic came, and then it broke through that level again. It rallied to all the way to $45 per share level, and then failed to break it and came back, and then used the $30 per share level as support. It bounced off of this level a couple of times, and we can see that back when it was bouncing off of that level, it printed L1, L2, L3, and it failed to materialize. It dropped, and this trade would have been a loser. It then printed again L1, L2, L3. It came back into the moving averages, but then it bounces off of them. It broke through the $45 per share level. It used this level as a support, and then continued going all the way to $65 per share, where it found resistance again and then drop off of it. And then in the week of May, starting 19th of May 2025, it printed an exit signal from my previous L1, L2, L3. It would have been a profitable trade, and since it found resistance, since it printed the exit signal, it traded on sideways. Also, the ATR started printed above the price, which means that stock is either sideways or is preparing for a downturn. So for me, from technical perspective, I want to wait for ATR to be printed below the chart, which will mean the stock is ready for another uptrend. I want to see the MACD above 50%, which will mean there is momentum behind the move. And I want to see the long 1, long 2 printed, which will indicate that the stock is ready, has the momentum, it is an uptrend, and the moving averages are pointing upwards. In conclusion, from technical perspective, it is not a buy for me. I need to wait for a few signs, a few elements to align. So to wrap this up, Fidelity National Financial is not yet a 50% off, but FNF is a stable, cash-rich business with two engines, real estate, title insurance, and growing annuity platform. The company has strong margin, solid revenue, healthy cash flow, and a shareholder-friendly dividend and buyback program. Intrinsic value appears to sit between $55 and $75 per share, depending on your assumption. It's closely tied to housing cycle and credit markets. If those weaken, earnings can drop faster than you expect. If you believe the real estate market will stay stable and credit conditions remain healthy, FNF could be a reasonable long-term compounder. If not, you might want to wait for a better opportunity or avoid it altogether. As always, this video is not financial advice, just my research and interpretation meant to help you do your own due diligence. If you enjoyed this breakdown or you want me to analyze another stock, let me know in the comments. Thanks for watching.